A. Bala, who is Managing Director and Chief Executive Officer of Aditya Birla Sun Life Mutual Fund, joining in to talk about the significance of this. Bala, lovely talking to you as always, and good morning to you. Do you think that this, more than anything else, is sentimentally positive for the Indian investor, particularly the MF investor, small investor?
Yeah, good morning. Of course, it's a good period right now. There is a momentum it's picking up on the basis of hope that the tariff would come to some kind of conclusion, which will turn out to be more in favor of India. That's one. And second is the post-GST cut. While before GST cut and after GST cut during the festival season, this quarter most of the companies, especially in the auto sector, have actually done pretty well in terms of the sales numbers. But also actually improved the sentiment mainly towards the earnings of the companies falling in place. And third is the monetary policy has been quite supportive of growth in the country by way of series rate cut that they have considered in the past. They have provided liquidity in such a manner the banking industry is able to have enough money in their hands to actually increase the lending. To look at this quarter, the lending growth has been better than the deposit growth. So all these things are leading to make a belief that the Indian market will start performing better than what you have seen in the last 1 year. From mutual investors' point of view, it's a good development, given the fact that Indian retail investors have been continuously participating, reinforcing their faith on mutual fund industry by way of SIP, and that something would be something to cheerful for investors.
Mr. Balasubramaniam, do you reckon that the markets at large, whether it's the Nifty, Bank Nifty, or the broader end of the spectrum, are slated for much higher levels in the ensuing 6 months? 6 to 12 months?
I think there's a high probability for two reasons. One, as I just mentioned earlier, fundamentals are now getting shifted more towards a favorable zone. And second, US too will consider the rate cut, given the fact there is a bit of slowdown that's also being witnessed in the US economy. Therefore, there will be a series of rate cut. And as a result of that, I also believe we'll see two things happening. One, of course, FII's buying will start coming back. And second, as the sentiment gets better, in every market, there are pessimistic who remain short in the market. Therefore, some bit of short covering too would come. Therefore, you would probably see the broader index moving to the new high in the next 4 to 6 months period.
Mr. Balasubramaniam, Tamanna here, and so great to have you with us on NDTV Profit. Thank you so much for your time on what is an important day. For a lot of viewers who look at equity markets, of course, for their own trades, but also from the perspective and the lens of what's happening with their SIP and their mutual fund investments, what is your message for them? Can they expect great returns in the next 12 months, looking at how the market forecast is, and have we turned that tide?
I think the experience so far, if you go by the experience, definitely the Indian the mutual funds have given reasonably good return as against some of the traditional investment that investors would have made. So the great return, I think, should be considered one linking to the nominal GDP. Today, if you look at nominal GDP, is close to about 8.5–9%. Given the fact that inflations are low, in general, the corporate earnings goes between 11 to 12%. Therefore, investor expectation should at least be kept close to these kind of numbers. And as and when we actually get into animal spirit in the economic growth, definitely the additional return will come as a result of that. I think what is most important for investor is one, continuing to keep their investment by your SIP and keep the investment for a longer period. Don't get carried away by the short-term return not being up to your expectations. Therefore, start wondering what should be the investment. Instead of that, they should continue to keep their investment for 3 to 5 year time period. Then you naturally get to normal GDP plus 2–3% return you get, which is what I think one should expect. Anything that you get with the exceptional return that we have seen in the last 4 or 5 years, those exceptional returns should at least be considered as a bonus rather than setting that as a norm.